Welcome to the Syngenomics, which is a very important one on the Capex cycle. The GDP advance estimates announced last week showed a very strong rise in investments, or what the GDP data calls gross fixed capital formation. Investment is seen rising by a strong 7.8% for the full year, real GDP, versus 7.1% last year, and for only the second half of this year, investment is seen growing by 8.1%, 7.6 in H1 and 7.4 year ago H2. So strong data. The data also shows that if one went only by nominal GDP, the share of investment in total GDP is 30% or 107 trillion rupees. Now the central government's capex is budgeted at 11 trillion. While the states have budgeted around 10 trillion, they don't always reach that number, which means over 80 trillion or 80% has to come from the private sector. So is the private sector capex that good? That's the question we're asking, and joining us is Mahesh Vyas, founder and managing director of the Center for Monitoring the Indian Economy, and K. Ravichandran, chief rating officer at ICRA. Gentlemen, good morning and thank you very much indeed for your time. Mahesh, directly that question to you. Your private sector data that you gave me, and we will flash it, is showing a seminal step up after around 2022. But is it strong enough? What's your overall sense?
I think it is strong. It's not great. It's not like the roaring investment cycle that we had a few decades ago, but it certainly is perceptible. Okay. Compared to what we saw in the preceding 5 quarters, the most recent 5 quarters certainly show there's a pickup in investment, and that investment is led by the private sector. And happily, that's also led by the manufacturing sector. So I would say that there are good tidings indicating that private sector investments are picking up.
Okay, but what about the completion? You also gave us a list of completed projects, and whereas at this, a decade ago, the percentage completion was about 25%. Now the percentage completion seems to be only 10%.
Yes. Nevertheless, the completions this year in the recent past compared to the earlier times is still better. I agree that the completion rate has slowed down, but I think these numbers will get revised. Okay. The earlier numbers are fully revised, all revisions taken care of, whereas the most recent year's numbers will get revised upwards, and this difference will reduce. Okay. And nevertheless, this doesn't take away from the starting of an investment cycle, which is you begin by new investment announcements. Okay. And it takes time for completions to catch up.
Fair enough. And FY24 seems to be really strong with private sector investments at some 32 trillion in terms of announcements. Mr. Ravichandran, thank you for your patience. Well, the eye-opening part of the private capex cycle report that ICRA put out is that private sector actually forms a very small part of overall investment. It's only 32%. And within that, the listed universe is only contributing 5% of overall investment. Can you give us a perspective? Is that 5% at least growing?
Yeah, so in the case of private sector capex, the story is very different between listed and unlisted companies. Okay. If you look at the top 20 business groups in India, most of them are going ahead with their capex plans. Whether it is in the new economy, like, the renewable energy, battery storage, pump storage, and electric vehicles, and so on and so forth, in addition to traditional old economic sectors like steel, refineries, petrochemicals, and so on and so forth. In our estimate, capex with these large companies, industrial groups, has been growing in double digits, 12 to 13%. Okay. Whereas the story is very different in the case of unlisted space. Unlisted space accounts for almost 80 to 85% of the overall capex. That is where the problem lies in, where we believe the capex has been muted and it has been growing in single digits, perhaps 4 to 5% kind of a growth. A lot of SMEs and small enterprises, where because of the external demand environment and domestic related demand related factors, there was no need to add capacity, and import threat was also fairly at a high level. Because of that, unlisted space is where, perhaps we require more attention. On the listed space, large conglomerates, they are pretty much going ahead with their, stated capex plans.
Okay, but Mr. Ravichandran, are you getting the sense that Mahesh Vyas's data is showing that there is a kick up from, say, post-COVID, say, 23, 24?
Yeah, certainly. One can see that from the, the wholesale credit growth as well. While till now, one of the major issue has been that companies were not borrowing much. While capital formation was happening, it was not getting reflected through credit growth because a lot of the capex was getting funded through internal accruals, and there was no need to tap either the bond market or the bank loan market in a meaningful way. But of late, even that also has been gradually showing signs of improvement, and largely it is coming from the both the kind of sectors, clean energy sectors as well as old economy sectors. We believe the capex has been inching up, and largely to do with domestically to address the domestic demand, while export focused businesses are somewhat affected. But with regard to domestic demand per se, whether it is steel consumption, cement demand, or oil and gas, petrochemicals, etc., where it is largely domestically focused, and to the extent that there is no need to be worried about demand related issues.
Fair enough. Mahesh, CMI has been doing this for what, last 3 decades or even longer, the collection of private sector data. I think I came to the CMI library as a student, maybe in the late 80s, if I remember right. Now, what is the perspective you have? You're saying that there is this very good kick up in overall investment as well, post 22. How does it compare with the historical trend?
Well, so one needs to see the nature of the cycle. That there has been a prolonged, rather very prolonged period of extremely anemic growth in private capex. A very long period, almost from 2011-12.
Okay.
And compared to that, in the recent times, there is a pickup from 22, 23, and so on and so forth. That, compared to the most recent part, is a perceptible increase. But compared to what we saw in the, let us say, in the decade of the 1990s, that was something completely different. That was an order of magnitude much bigger than what we saw now. And I also agree that the investments are more concentrated in the larger enterprises, in the larger conglomerates. So the smaller companies are not investing as aggressively, but there is a new thing now is that there are many more startups coming with very aggressive capex plans, not talking about the IPOs, which are largely not capex, but still there have been in the recent past a lot of new capex which is happening by new startups. So the nature of investments is changing. It is not as aggressive as it used to be in the past, but there is a change. There is not just the capex database that you alluded to, Lata, that I will point to. I always compare this capex data with the net fixed assets growth of the listed companies and even the unlisted companies. And if I see the listed companies, because we have the September 25 results now, what we see over there is if I look at the 5 quarters ending September 2022, the average growth in net fixed assets was 4.5% year-on-year growth. And in the next 5 quarters, that growth goes up to 6.5% average. And the average is a good average. These are not some outliers cancelling out. They're very close. 4.5 moves up to 6.5. But September 25, that number is 9.5. So, this is an indication that there is an increase in the capex cycle going on. These numbers used to be of the order of 20% in those great days.
You mean 90s or 2000s?
In the 2000s. Okay. In the 90s, sorry, in the 90s. 97, 98, 96, 97, 98, 99, that period, we saw 20% year-on-year growth in capex. But let's not belittle even this 9.5%. It's come after a very long time.
Okay. Well, that's good to hear. Mr. Ravichandran, a slightly unfair question in the sense it's an economist's question. Both you and Mahesh agree that you are seeing a step up in private sector investment from in the post-COVID period. And we know the data is very clear that government capex has, risen manifold in the period. Let me just inform our viewers that government forms a very small part. Central government, it's just 10% of the overall GFCF, gross fixed capital formation. But that said, Mr. Ravichandran, would you say that points out to a period of higher productivity and higher margins since so much investment is happening?
Yeah, in fact, you would have to look at this ICAR, the incremental credit output ratio.
Yes.
Where, India has been one of the best, in terms of, capital efficiency. So from that point of view, our investments are really delivering in terms of, achieving this kind of a growth. That is something one can see from the, the stated, the economic indicators.
Okay. Yes, sir. ICOR, I didn't want to use the jargon, but you're right. Capital output ratio, incremental capital output ratio does seem to be falling. You're getting more output per unit of capital that's coming in. Mahesh Ras, would you say therefore that we are on the inflection point of probably a good capex cycle?
There are indications to that. I would still not say that we are at that inflection point, but we certainly seem to.
Okay. And Ravichandran, last word?
Yeah, I mean, I wouldn't say, full-fledged kind of a, recovery. Gradual recovery is seen, and for us, key thing would be to address this external tariff-related headwinds. The moment, we are clear on that, I'm sure, there can be sustained, recovery on the growth side.
Okay. Yes, I take your point that their tariff introduces a great deal of uncertainty, but even global growth has not been impacted as much by tariffs as we thought. Global GDP has done reasonably well in 2025. Plus, we are more a domestic-facing economy. So one hopes that, that uncertainty need not stop what both of you agree is a fledgling private capex cycle that has started. But I just want to remind everyone of the data that both of them are putting in. Listed companies form a very small part of the overall capex. Households form the largest part. Therefore, we want the real estate cycle also to continue because dwellings is a large part of India's gross fixed capital formation. A great start to the new year from two people who are, very sincere observers of the economy and very informed observers. Thank you very much, Mahesh and Mr. Ravichandran. We have to wrap up on Bazaar. Chart Busters coming up.